Prior to his appointment to the board, Mr. Powell was a visiting scholar at the Bipartisan Policy Center down there in Washington, D.C., and he was a partner at the Carlyle Group. Mr. Powell served as Assistant Secretary and as Undersecretary of the Treasury under George H.W. Bush, with responsibility for policy on financial institutions, the Treasury debt market, and related areas. Prior to joining the administration, he worked as a lawyer and investment banker in New York City. In addition to service on corporate boards, Chair Powell has served on the boards of charitable and educational institutes, including the Bentheim Center for Finance at Princeton and the Nature Conservancy of Washington, D.C. and Maryland. He received his A.B. in politics from Princeton University in 1975 and earned his law degree at Georgetown in 1979. And in the many articles I read about Chair Powell, again and again, it talked about his commitment to his civic duty, and it is a real honor to have him here today to give his perspective on what he's seeing from the Federal Reserve. Please join me in welcoming Chairman Powell.
Thank you very much, Lisa, and please be careful going down those stairs. It's a great pleasure and an honor to be here to speak today at your 60th annual meeting / birthday party, or anniversary party maybe. Since 1959, NABE has promoted the use of economics in the workplace and advanced the worthy purpose of ensuring that leading American businesses benefit from the insights of economists. Today, I'm going to focus on our ongoing efforts to promote maximum employment and stable prices. And I'm pleased to say that by these measures, the economy looks very good. The unemployment rate stands at 3.9%, near a 20-year low. Inflation is currently running near the FOMC's 2% objective. And while these two top-line statistics don't always capture an accurate picture of the overall state of the economy, a wide range of data on jobs and prices does support a positive view. In addition, many forecasters are predicting that these favorable conditions are likely to continue. For example, the medians of the most recent projections from FOMC participants and from the Survey of Professional Forecasters, as well as the most recent CBO forecast, all have the unemployment rate remaining below 4% through the end of 2020, with inflation staying near 2% over the same period. From the standpoint of the dual mandate, this is a remarkably positive outlook. Indeed, I was asked at the press conference last week whether these forecasts are too good to be true, which I have to admit was a reasonable question. Since 1950, the U.S. economy has experienced periods of low and stable inflation and periods of very low unemployment, but never both for such an extended period of time as is seen in these forecasts. Standard economic thinking has long offered an explanation for this. If unemployment were to remain this low for this long, employers would be pushing up wages as they compete for scarce workers, and rising labor costs would feed into more rapid price inflation paid by consumers. Of course, this dynamic, as you well know, between unemployment and inflation is known as a Phillips curve relationship, and at times it can pose a fundamental tension between the two sides of the Fed's dual mandate. Recent inflation and unemployment have some analysts asking, is the Phillips curve dead? Others argue that the Phillips curve still lurks in the background and could reemerge at any time to exact revenge for low unemployment in the form of high inflation. So my comments today have two objectives. The first is to explain how changes in the Phillips curve help account for the somewhat surprising but broadly shared current forecasts of very low unemployment with inflation remaining near 2%. And at the risk of spoiling the surprise, I do not see it as likely that the Phillips curve is dead or that it will soon emerge to exact revenge. What is more likely, in my view, is that many factors, including better conduct of monetary policy over the last few decades, have greatly reduced but not eliminated the effects that tight labor markets have on inflation. However, no one fully understands the nature of these changes or the role they play in the current context, and common sense suggests that we should beware when forecasts predict events seldom seen in the data. Thus, my second objective today is to explain, given this uncertainty about the unemployment-inflation relationship, the important role that risk management plays in setting monetary policy. And I will explore the FOMC's monitoring and balancing of risks, as well as our contingency planning for when risk becomes reality. Let's start with a look at the modern history of jobs and inflation in the United States with Figure 1, which shows headline inflation in red and unemployment in blue from 1960 to today and extended through 2020. And here we're using the average of the median projections from both the FOMC participants and the Survey of Professional Forecasters and the CBO projections. As the figure makes clear, at least if you're this close to it, a multi-year period with unemployment below 4% and stable inflation would, if realized, be unique in modern U.S. data. To understand the basis for these forecasts, it's useful to contrast two very different periods that are included in Figure 1. First, from 1960 through 1985, and second, the period from 1995 today. The first period, of course, includes the Great Inflation, and the latter includes both the Great Moderation and the distinctly immoderate period of the global financial crisis and its aftermath. So Figure 2 shows unemployment and core rather than headline inflation in these two periods, with the Great Inflation period on the left and the more recent period on the right. While our inflation objective is headline inflation, switching to core inflation makes some relationships clearer by removing a good deal of the variability due to food and energy prices, variability that is not primarily driven by labor market conditions or by monetary policy. As you see, there's a dramatic difference in the unemployment-inflation relationship across these two periods. During the Great Inflation, on the left, unemployment fluctuated between roughly 4% and 10%, and inflation actually moved over a similar range. But in the more recent period, the unemployment rate also fluctuated between roughly 4% and 10%, but inflation has been relatively tame, averaging 1.7%, never declining below 1% or even reaching 2.5%. Even during the financial crisis, core inflation barely budged. So as a thought experiment, look at the right panel and imagine that you could only see the red line, which is inflation, and not the blue line, which is unemployment. Nothing in the red line hints at a major economic event, let alone the immense upheaval around the time of the global financial crisis. Also notice that in each period, there's only one episode in which unemployment drops below 4%. In the late 1960s, unemployment remained at or below 4% for 4 years, and during that time, inflation rose steadily from under 2% to almost 5%. By contrast, the late 1990s episode of below 4% unemployment was quite brief, and during that episode and the surrounding quarters, inflation was reasonably stable and remained below 2%. To explore the Phillips curve relationship in these two periods more closely, we need to bring in the concept of the natural rate of unemployment. And in standard economic thinking, an unemployment rate above the natural rate indicates slack in the labor market and tends to be associated with downward pressure on inflation. Unemployment below the natural rate represents a tight labor market and is associated with upward inflation pressure. So Figure 3 repeats Figure 2, but replaces unemployment with labor market slack, again in blue, as measured by the rate of unemployment minus CBO's current estimate of the natural rate of unemployment at each point in time. Periods of tight labor markets are shaded. During the Great Inflation period, again, on the left, inflation generally rose in the tight shaded periods and fell in the unshaded periods, just as conventional Phillips curve reasoning predicts. But from 1995 to today, however, the large and persistent swings in the gap between unemployment and the natural rate were associated with, at most, a move of a few tenths in the inflation rate. Comparing the shaded and unshaded regions, you might see some association between slack and minor ups and downs in inflation, but the pattern is not at all consistent. And it's evidence like this that fuels speculation about the Phillips curve's demise. So whether it is dead, sick, or merely resting, Many of the questions about the Phillips curve come down to figuring out what changed between these two periods and why. So let's turn to a conceptual framework for examining these questions more systematically. And a natural starting point is the simplest form of a Phillips curve equation, which posits that inflation this year is determined by some combination of current labor market slack. This is figure 4. Current labor market slack, which is labeled slack here, and inflation last year, which is labeled inflation at T-1, as well as some other factors that I'm going to leave aside for purposes of this discussion for now. So the value of B is often referred to as the slope of the Phillips curve. With a larger value of B, any change in labor market slack translates into a bigger change in inflation. As we say, as B increases, the Phillips curve steepens. The value of C determines inflation's persistence, that is, how long any given change in inflation tends to linger. As the value of C increases, higher inflation this year translates into higher inflation next year. A particularly nasty case arises when both B and C are large. In this case, slack has a large effect on inflation, and that effect tends to be very persistent. One implication of a larger C is that if a boom drives inflation up, it will tend to stay up unless offset by a subsequent bust. Figure 5 shows regression estimates of B on the left and C on the right, computed over 20-year samples starting with the sample from 1965 to 1984 and including each 20-year sample through 2017. On the right, you see that during the Great Inflation samples, the value of C is near 1, meaning that higher inflation one year tended to translate almost 1-for-1 into higher inflation in the next year. The left panel shows that the Phillips curve is also relatively steep in the Great Inflation samples, with 1 extra percentage point of lower unemployment converting into roughly a half percentage point of higher inflation. Thus, the Great Inflation presented that nasty case that I mentioned just a moment ago. Fortunately, things changed. As you can see, the estimates of both B and C fall in value as the estimation sample shifts forward in time. In the most recent samples, the Phillips curve is nearly flat, with B very near 0 and C at about 0.25, meaning that roughly 1/4 of any rise or fall in inflation carries forward. These results give numerical form to what we see back in panel 3 covering the recent period, which is that large and persistent moves in the unemployment gap were associated at most with modest transitory changes in inflation. Now, these developments amount to a better world for households and businesses which no longer experience or even fear the scourge of high and volatile inflation. To provide a sound basis for monetary policy, it's important to understand what happened and why, so we can avoid a return to the bad old days, at least for inflation purposes, of the 1970s. Like many, I believe that monetary policy has played a central role. To understand the mechanism for that, let's ask how central banks could, presumably inadvertently, amplify and extend the duration of inflation's response to labor market tightness. To do so, the central bank could persistently ease the stance of monetary policy in response to an uptick in inflation. Now, no responsible central banker today would intentionally do this, but a good deal of research suggests that during the Great Inflation, misunderstandings about the way the economy worked led the Fed to effectively behave in this manner. Some policymakers may have believed the misguided notion that accommodating permanently higher inflation could purchase permanently higher employment. Other policymakers misperceived the level of the natural rate of unemployment, which we now believe had shifted up markedly in the 1960s. With the higher natural rate, the labor market was much tighter and provided much greater upward pressure on inflation than policymakers realized in real time. As a result, they were continually behind the curve. The channel through which monetary policy can amplify and extend inflation's response to shocks becomes even stronger when we take account of expectations. If people come to expect that upward blips in inflation will result in ongoing higher inflation, they will build that view into wage and price decisions. In this case, people's expectations become a force adding momentum to inflation. And breaking inflation's momentum can require convincing people to change their minds and their behavior. Never an easy task. And arguably, this is why a federal funds rate near 20% or 10% in real terms was required in the early 1980s during the Volcker disinflation to turn the tide on high inflation. The cost in the form of very high unemployment was clear in those figures. The Great Inflation taught us then that a main task of monetary policy is to keep inflation expectations anchored at some low level. This idea is behind the adoption in recent decades of an inflation target, such as the Fed's 2% objective, by central banks around the world. When monetary policy tends to offset shocks to inflation rather than amplifying and extending them, and when people come to expect this policy response, a surprise rise or fall in labor market tightness will naturally have smaller and less persistent effects on inflation. Research suggests that this reasoning can account for a good deal of the change in the Phillips curve relationship. It's also likely that many other factors contributed to changes in inflation dynamics over recent decades, and we don't fully understand the causes and implications of these changes, which brings us to risk management issues that I'll take up now. To set the stage, let's return for a moment to the situation facing the FOMC. The baseline forecast of most FOMC participants and a broad range of others show unemployment remaining below 4% for an extended period with inflation steady near 2%. And I've made the case that this forecast is not too good to be true and does not signal the death of the Phillips curve. Instead, this outlook is consistent with evidence of a very flat Phillips curve with inflation expectations anchored near 2%. But we still have to face the cautionary advice to beware when forecasts point to rarely seen outcomes. And as a way of heeding this advice, the committee takes a risk management approach, which has three important parts: monitoring risks, balancing risks, and contingency planning for surprises. So let me describe a few of the risks and how we are thinking about those today. The first is the risk that inflation expectations might lose their anchor. We attribute a great deal of the stability of inflation in recent years to the anchoring of longer-term inflation expectations. And we're aware that it could be very costly if those expectations were to drift materially. This is slide 6. As you probably know from our public communications, we carefully monitor survey and market-based proxies for expectations, and we don't see evidence of material shift in longer-term expectations. The survey measures in particular have been steady for some time. The financial market-based measures include both an expectations component and a volatile inflation premium component, so they tend to move around much more than the surveys. But we don't see much evidence of a material change in those measures either. The risks to inflation expectations are, of course, two-sided. Until this summer, inflation had remained stubbornly below 2% for a number of years, and major economies in much of the world have been struggling mainly with disinflationary forces. Thus, we have been and will remain alert for possible downward drift in expectations. Some argue the contrary case, that by only gradually removing accommodation as the unemployment rate has fallen, the FOMC may fall or have fallen behind the curve, thereby risking an upward drift in expectations. From the standpoint of contingency planning, our course is clear. Resolutely conduct policy consistent with our symmetric 2% inflation objective, and stand ready to act with authority if expectations drift materially up or down. A second risk is that labor market tightness or tightness in other parts of the production chain might lead to higher inflation pressure than expected. Call this the revenge of the Phillips curve scenario. As I mentioned, the FOMC carefully monitors a wide array of early indicators of inflation pressure to evaluate this risk. Wages and compensation data are one important source of information, and these measures have picked up some recently, but in a way that is quite welcome. Specifically, the rise in wages is broadly consistent with observed rates of price inflation and labor productivity, and therefore does not point to an overheating labor market. Further, higher wage growth alone need not be inflationary. The late 1990s episode of low unemployment saw wages rising faster than inflation plus productivity growth without an appreciable rise in inflation. Despite what shows up in the aggregate wage and compensation data, however, I'm sure that, like we are, many of you are hearing widespread anecdotes about labor shortages and increasing bottlenecks in production. For example, as shown in Figure 7, the words shortage and bottleneck are increasingly appearing in the Beige Book. The message we are hearing in our conversations is supported by a wide range of more conventional measures. For example, the NFIB member survey increasingly reports that job openings are hard to fill. Further, these businesses now list quality of labor as their most important problem, as opposed to the much more typical report of poor sales. We review a wide variety of measures of this type, and these indicators show what I think most business people see: an economy operating with limited slack. Notice, however, that these measures are near levels that prevailed in the late 1990s or early 2000s, a period where, as I mentioned, core inflation remained under 2%. While the late 90s case proves that elevated values of these tightness measures do not automatically translate into rising inflation, a single episode provides only limited reassurance. Thus, we take seriously the possibility that tight markets for labor or other inputs could provide greater upward pressure on inflation than is seen in the baseline outlook. Our best estimates, however, suggest that as long as inflation expectations remained anchored, a modest steepening of the Phillips curve would be unlikely to cause a significant rise in inflation or demand a disruptive policy tightening. Once again, the key is anchored expectations. A third risk, in this case essentially an upside risk, is that the natural rate of unemployment could be even lower than current estimates. Some have argued that the Fed should be removing policy accommodation much more slowly, or not at all, pushing the economy to see if the natural rate of unemployment is lower still. Advocates of this view note that over the past several years of policy normalization, the economy has continued to strengthen and unemployment has fallen, but inflation has remained quiet. As I discussed in a recent speech, many analysts have accounted for the lack of rising inflation pressure by lowering their estimate of the natural rate. For example, just since the start of 2016, the unemployment rate has fallen about a percentage point, and estimates of the natural rate by four well-known sources, including the median of the FOMC SEP, have fallen over that period between 0.3 and 0.7%. If the natural rate is now materially lower than we believe, that would imply less upward pressure on inflation, which is the flip side of the revenge of the Phillips curve scenario. And our policy of gradual interest rate normalization represents the FOMC's attempt to take both of these risks seriously. Removing accommodation too quickly could needlessly foreshorten the expansion. Moving too slowly could risk rising inflation and inflation expectations. So our path of gradually removing accommodation while closely monitoring the economy is designed to balance these risks. In wrapping up this discussion of the risks, I should emphasize that I've chosen to focus on three risks, all of which have to do with the Phillips curve. There, of course, are myriad other risks, and just to name a few, global growth, economies abroad, the effect of ongoing trade disputes, and financial stability issues, among others. So I hope my discussion of these particular risks give a sense of how we approach these issues. Many of us have been looking back recently in the last weeks and months on the decade that's passed since the depths of the financial crisis. And in light of that experience, I'm glad and lucky to be able to stand here and say that the economy is strong, unemployment is near 50-year lows, and inflation is roughly at our 2% objective. And that the baseline outlook of many forecasters, inside and outside the Fed, is for more of the same. This historically rare pairing of steady low inflation and very low unemployment is a testament to the fact that we remain in extraordinary times. Our ongoing policy of gradual interest rate normalization reflects our efforts to balance the inevitable risks that come with extraordinary times, so as to extend the current expansion while maintaining maximum employment and low and stable inflation. Thanks very much, and I'll look forward to your questions.
So you all have little cards on your tables, and you are welcome to write a question. Constance, front run all of you with question, but I'm actually not going to ask Constance's question right now. I'm going to ask a question that I've been interested in pursuing. with Chair Powell. And again, thank you so much for coming to the conference. We really appreciate your joining us today. And as you mentioned, it's 10 years since the failure of Lehman, and the Federal Reserve has, and the global central banks of the world have introduced many, many new tools for dealing with the environment that they experienced over the last decade. And we heard from you today about a lot of normalization, an unemployment rate that was almost unthinkable a few years ago, a very benign inflation environment. And I'm interested in what tools do you think that the Fed is the Fed going to continue to use the tools that they developed over the last decade, or do you think that we go back to an old form of monetary policy as we proceed over the next several years? The most recent Fed statement was that accommodation, we dropped the term accommodation, but does that imply that we are going to go back to the old ways, or is this continues to be a brave new world?
Let me start just a second before we get to monetary policy. I'll come to monetary policy. First, thanks for inviting me. It's great to be here. So I think the main thing that we all learned after the financial crisis, or a main thing, is the overwhelming importance of the stability of the financial system. So, and that wasn't I think that was where the surprise was, the kind of run on the financial system dynamics that emerged were the thing that we didn't see coming, and now we're very focused on that, and we've spent 10 years focused on policies that will strengthen the financial system, limit the amount of maturity transformation, particularly the kind of unstable maturity transformation that funded many large institutions, but a very broad program. So I think that's a big part of what we've done. But coming to monetary policy, we actually, I think at the meeting before this last one, did really a deep dive on what we know about monetary policy at a very good time in the economy when unemployment is low, inflation is right at target. So, and the question we asked ourselves is, what does our toolbox look like, and how would it work through the cycle, not just in good times like this, but also in different parts of the cycle. And I think we came away thinking that we have good tools that both forward guidance and, our interest rate tool will always be the principal tool that we use, but also the forward guidance provided support for the economy in a meaningful way during the financial crisis, and so did asset purchases. So I think the vast bulk of the research shows that these were helpful tools. It is also the case, though, that we are in an era of lower real rates and lower inflation. So long-term rates have been coming down sort of gradually for 35 years. So it is possible, even likely, that we'll be nearer the zero lower bound than we have been historically, and that does raise questions about the efficacy of the toolkit in that case. There's no question, though, that the committee would use the tools that it has, including the ones that we used during the financial crisis, and we think that they worked. And we're also thinking about, are there ways to adjust the toolbox in ways that would make the inflation target more credible and give us better ability to serve the goals that Congress has assigned to us.
Great. So one of the questions, and wonderful questions from the audience, thank you very much. Has been about a remarkably positive economic environment that we find ourselves in today, but this is actually being coupled at the same time with a rising fiscal debt. And from a Fed policymaker's standpoint, is this a cause for concern in terms of if we saw a future drop in demand, how we would be able to respond?
So we try to stay in our lane and not critique any particular fiscal policy. And also fiscal policy is very important and obviously very powerful, but it's just one of the factors that we consider. And obviously fiscal policy is providing real support to demand this year and probably for the next couple of years. In terms of there's a possibility of supply side effects. We'll have to see how those emerge. Longer term, we're not on a sustainable fiscal path. We haven't been for many years. And these last innovations in fiscal policy, at least in the medium term, have probably reduced the amount of fiscal space that we have to react. I still think the United States has meaningful fiscal space, though. Our situation is more of a long-term problem. So there's probably still room for fiscal policy to support demand. But still, this is a good time to be working. This is the top of the cycle, and a good time in the cycle, let's say. And it's a good time to be working on putting our fiscal house in order.
Great. Multiple questions about that the terminal Fed funds rate is in the range of 3 to 3.5%, but the traditional response to a recessionary environment has been a 550 basis point cut in rates. Is the Fed considering the use of, certainly QE is in the toolkit, but what are your thoughts on the use of negative interest rates and perhaps even asset purchases beyond the ones that the Fed is already engaged in?
So as I mentioned a meeting or so ago, we did a deep dive on and looked at our toolkit, and then we agreed to come back next year and think about at another meeting and think about a range of ways. What are the ideas that under existing law, without asking for Congress to change the law, we could adjust the way we use our tools, and which ones of them would provide the most support? And we're going to open up and try to seek lots of input about that question next year. And as I mentioned, though, we will use the tools that we used in the financial crisis to the extent we have to. We would hope to be able to use our long-standing tool that we understand best, and that is interest rates. But the other tools are there and will work if needed, which we hope is not soon.
Great. I was struck by your presentation on both the Phillips curve and trends for inflation and this dramatic deceleration over the last 2 decades or a few decades. And one of the questions is about globalization, and we can sort of track some of that deceleration in inflation pressures to perhaps globalization. Is there some concern that perhaps the change in trade policy may actually create an inflationary change in tone?
Trade policy being another area that we try to stay in our lane, but I can certainly talk about it, but I have to say that at the start. Yes, it's so potential tariffs could increase prices, and then the question would be, is it just a price level increase or does it actually stoke higher inflation? We don't see that in the data. It's really not in there. It's hard to find any imprint in the data. I gather you would probably have the same reaction, but you don't really see much in there, and it's probably early to be seeing effects from changes in trade policy. But in the first instance, though, a tariff would just increase prices rather than inflation itself.
So one of the favored indicators of, I think, all economists in this room is the shape of the yield curve. And we've certainly seen the yield curve start to flatten over the past year. And my question is, how do you think of the yield curve? How do you interpret the shape of the yield curve, and how it should or should not inform Fed policy?
A downward sloping yield curve could mean that policy is currently tight, in the sense that the short-term rate is higher than the longer-run neutral rate. It might mean that. Or it might mean that term premiums are negative. Mm-hmm. But it is true that there's an empirical regularity between an inverted yield curve and a subsequent recession. But I sort of look at it as, going back to where I started, we know why short-term rates are going up. They're going up in part because it's meant to map our policy path out. A lot of things go into long-term rates, so they can be low for term premium reasons, they can be low for expectations reasons, and to the extent, if you can sort of pull out of them an estimate of the longer-run neutral rate, then you can ask yourself whether policy is tight. And even by those measures, policy is not tight at this moment. So I don't see that. And I would always say, too, that it's just one of many things we look at. We do look at it, we talk about it, you can tell from the minutes, but it's one of a range of factors that we're keeping our eyes on.
So just to sort of take a different perspective, and it's always, I'll put a plug in for the closing session that I'm on the panel for, which is what have we learned 10 years on from the financial crisis. But one of the things that I always think is interesting is what we learned 10 years ago is probably not going to be what we learn in the next 10 years. And one of the questions here is, what tools will the Fed likely use if headline inflation exceeds targets? So maybe a pretty standard answer, but curious if you have any thoughts on that.
So if in other words, if inflation comes in above target, I mean, we would always, our first choice, I think, would always be to use the federal funds rate and work through interest rates. That's what we have experience with over decades and cycles, and that would be our first choice. If embedded in that is a question of would we start selling assets, the answer is no.
Yeah.
We're going to stick to our balance sheet reduction program because it's working very well, and I wouldn't want to send any signal that that we'll revisit that anytime soon.
Great. One of the ongoing discussions within the markets is what form of labor price inflation is a central focus for the Federal Reserve. And so when we think of the J. Powell dashboard on inflation, what are some of the things, in terms of labor inflation, what are some of the key indicators that you're interested in watching?
Key indicators of labor inflation.
Yeah.
So, we have the big four are ECI, average hourly earnings, Atlanta wage tracker, and compensation per hour. But we also look at, a bunch of other things. And if you take those four, by the way, and you look at where they were 5 years ago, they were clustered around 2%. If you look at them now, they're clustered around 3%. So very gradually and in an uneven way, there is an increase.
Great. Wonderful. Maybe I'll ask about the use of negative interest rates and the experience of, for example, the Bank of Japan and the European Central Bank. Is there any lessons to be learned from their experience?
You talk to, we didn't deploy, or I think really seriously consider using negative rates in the United States. Didn't feel like we just didn't. And, I think we can watch and see how that experience has worked for the other central banks that did. It's not something that we're, currently examining, but in theory, it's a tool, and I think we have the benefit of being able to watch other central banks as they try to come out of negative rates. I think, again, we can benefit from their experience and talk about that down the road.
Great. So with the gradual normalization of policy that we've seen taken over the last year and a half, perhaps one of the downsides may be that this very gradual normalization is creating a very benign volatility environment and perhaps creating asset price bubbles. Do you think that could be a risk that we're taking with the gradual policy?
It's a really interesting question. I think there are sort of three separate things going on. One, there's our policy. Two, there's this secular decline in interest rates that was happening anyway, that's been going on for 35 years, really. And three is that we're getting into, a long expansion. And I think all of those things, what you see as an expansion like that goes on is you sometimes see low volatility, you see credit spreads coming in, you see risk spreads coming in, and that kind of thing. So what causes it? It could be any of those three things. It could be all of those three things. There was as you may have seen, there was a big exchange on Twitter last weekend among a bunch of economists about this very question. You probably all saw it.
Yeah.
But I read that with real interest. And I think, look, the dire predictions that low rates in QE would produce either high inflation or financial instability, it didn't come true. It didn't happen. And I was one who was worried about that. I was very worried about really more the financial instability issues and high asset prices and high leverage. You don't see it. Banks are taking less risk and they're better capitalized. Households are not taking risks. They're not borrowing. Their saving rate is high. It hasn't turned up. You do see high asset prices by historical standards, but you don't see, I think, a really bad case of financial instability that many had been concerned about from unconventional monetary policy or low for long.
So one of the comments that I see here has been that the conference here today, or over the last couple of days, has been actually very focused on the U.S. economy, very good information coming through from the U.S. economy, low unemployment, benign inflation, strong growth, et cetera. When we look globally, however, we see some wrinkles in that story, particular emerging markets, et cetera. Do you think that is something that we should start paying more attention to?
I don't know how much attention you pay to it now, but it's very important to pay attention to it. We of course devote a lot of resources and thinking to that, and that's one of the principal risks that we face is that as you look around the world, I think you still see a reasonably positive picture. You see maybe slightly less positive than at the beginning of this year. You see a bit of a slowdown in the advanced economies, and you see really just a handful of emerging market countries experiencing significant turmoil, and then I would say some level of pressure broadly, but not a broad situation where there's lots of instability and lots of pressure on emerging markets. So I think growth is still healthy, but maybe under a little bit of pressure.
Great. And I'll finish with sort of, I guess, a classic question that you probably hear pretty regularly.
Bitcoin?
No, but I'll ask you about it if you want me to. Well, actually, one of the things that you are touted as is you have had the shortest post-Fed meeting Q&A of any Fed chair since they started. So congratulations.
Thank you.
Less is always more in my book. But one of the questions is actually, are you interested in moving to a Q&A after every Fed meeting going forward?
So we're going to do a press conference after every meeting, beginning with the January FOMC meeting. So we did make that decision, and that's something I'm really looking forward to. I think it's a good chance to get out and talk about what the committee decided, and this will be so not just the SEP meetings, but all of the meetings there'll be a press conference. It seems like a good improvement in transparency and just in communication generally. So I'm happy to do it.
Great. So I will finish this up and say thank you very much for spending some time with us. Really appreciate it. And from the entire membership of NABE, thank you for being here today.
Thank you. Thank you, Lisa.
All right.
This
Always
has got to be hard going
right.
down. Pleasure. Thanks. Okay. Thank you very much. Thanks a lot. Good fun. Hey, how are you? Good to see you, George.
I think it was right out of
Julia,
here now.
yeah, we have to go get our picture taken and then catch an airplane.
All right. Great to see you. Great to see you.
Thanks for the invitation.
Jay?
Really appreciate it.
Thank you for